Welcome to the new year. It's hard to believe it's already 2026. As we enter this next year, let's take a look at the market and determine if we should be risk on or risk off. My name is Brian Cannon, and welcome to Markets in 5. All right, so jumping into our first chart here, we got the S&P 500 on a daily basis. You can see we had this kind of consolidation where we were kind of bouncing. So we had these gains, right? And now we've kind of consolidated these gains where you're kind of bouncing up and bouncing down and bouncing up and bouncing down. And then it did just recently break back above this resistance line and came down and tested it yesterday. It's got a little support there from the 20-day moving average. So as long as it can hold that and kind of stay above this area of resistance. Anytime you breach resistance, in other words, you can't get through it. Once you do get through it, then a lot of times it becomes support. So as long as it kind of holds that support and continues to climb, everything looks good. The RSI up here, again, we want that to stay above 50, and it is. And so as of right now, everything looks pretty good on the S&P right now. So again, we're watching this area. If it does drop below the 20 and the 50-day moving average, then we would expect it to kind of continue in this range. And we would be looking for lower support down here, and then possibly the 200-day moving average down here. But that's a ways away. So we're kind of watching this area in here, but we'd love to see it just pop up and keep running. All right, this is one of the charts that we use to kind of determine risk on or risk off. And this is the NASDAQ, which is a more tech-weighted, a little bit more aggressive index relative to the S&P 500. Okay, so when this chart goes up, that's telling you that the NASDAQ is outperforming the S&P, and that you're better suited putting a little bit more risk on. Now, conversely, when the chart goes down, that means that the S&P is actually outperforming the index, meaning you've got some more blue chip companies in there, a little bit less tech, a little bit more diversified. So when that occurs, you want to take a little bit of risk off and kind of keep bouncing. But as you can see, over the long haul, it's definitely paid dividends to be invested in a little bit more risk, a little bit more tech. Obviously, as this AI world continues to evolve, you want to be in the players that are participating. So as long as this NASDAQ relative to S&P 500 chart is continuing to head up, it tells me that we want to be a little bit more risk on, a little bit more tapped into technology. So in this chart, it's kind of that same relative performance, only this time it's using the equal weight S&P 500, meaning all S&P 500 stocks kind of equally weighted relative to the cap-weighted S&P 500 index. The cap-weighted is obviously the largest companies consume the largest percentage of the index. So, for instance, the top 10 stocks within the S&P make up nearly 40% of the total index. So, when this relative performance chart is heading down, it's telling you that you want to be less diversified. You want to be a little bit more concentrated in the top stocks that are carrying the market. And you can see that over time, this is, I believe, a 15-year chart going back, or 10-year chart going back. But anyway, so as this relationship heads lower, that means that it pays to accept more risk, to be more concentrated in the top stocks, because that's what's carrying the market. When this relationship flips and you start to see the equal weight outperform the cap weight, it means that you want to be a little bit more diversified in your approach. You want to spread your risk amongst some of the companies that aren't so concentrated in the top 10. So this relationship for the last year or so, certainly over 2025, has been heading down, meaning you want to be more concentrated in the Mag 7 stocks, the Magnificent 7, top, largest, biggest stocks out there. That's the trade that worked all of last year. Now you're starting to see it lip up right here. And so if we break above this resistance zone, so this is a break we're watching for. If it continues to, for instance, run up, then that would say that we need to diversify more. We need to reduce our concentration and spread our risk amongst a larger pool of stocks. So that hasn't happened yet, but it is starting to pull up a little bit right here. So we are watching that very closely. So in wrapping up, you can see that everything's looking fine right now. I mean, obviously anything can happen this year. It's why we use technical analysis. We want to determine, is the trend technically trending up and we want to be in it, or have things started to roll over and we want to pull some risk off. As of right now, everything looks good, but we'll keep watching. But if you have any questions, give me a shout, and I will see you on the next Markets in 5.